Social Security is a little bit of a wacky system. You pay Social Security tax during your working years out of your paycheck, but then when you go to receive your benefit when you're retired, a lot of individuals have to pay tax on that money again. But there are strategies that we use as financial planners that when we're counseling our clients that they can use to reduce the amount of their Social Security benefit that is subject to taxation in the retirement years. And I'll be sharing those strategies with you today. Hello everyone, I'm Michael Ruger. I am the managing partner of Greenbush Financial Group. We are a firm that manages just over $500 million in client assets. And when we're counseling clients on Social Security and filing strategy and taxation, there are definitely strategies that could be implemented to reduce the overall tax liability that is paid on a Social Security benefit. So when you receive your Social Security, there's 3 levels that your Social Security could be taxed at. It could be 0, which means it's all tax-free. It could be 50% tax, or it can be 85% taxed. What determines what level your Social Security benefit is taxed at is based on the Social Security's provisional income formula, which includes your total AGI or adjusted gross income, plus any tax-exempt interest, such as municipal bond interest, plus 50% of your annual Social Security benefit. For example, if your AGI for the year is $20,000 and you receive $5,000 in municipal bond interest and your Social Security benefit is $30,000 for the year, your provisional income would be $40,000. Because remember, it's 100% of your AGI, 100% of your municipal bond interest, and 50% of your Social Security benefit to get to that provisional income amount. The taxation thresholds, whether you get it at 0%, 50%, or 85%, is different depending on your filing status. For single filers, if your provisional income is less than $25,000, you get your Social Security benefit completely tax-free. As single filers, $25,000 to $34,000, 50% of your benefit is subject to taxation, and single filers, $34,000 or more, 85% of the Social Security benefit is taxable at the federal level. For married couples that file married filing joint, if they have provisional income under $32,000, their Social Security benefits are 100% tax-free. If their provisional income is between $32,000 and $44,000, 50% of their Social Security benefit is subject to taxation, and once the provisional income gets over $44,000, then 85% of the Social Security benefit is taxable at the federal level. Now, just a quick note, when I say 50%, 85%, that doesn't mean you pay 50% tax on your Social Security benefit. It just means 50% of the total Social Security benefit that you receive is subject to taxation at the federal level. Now, depending on the state you live in, there are a handful of states that also tax Social Security at the state level, but most states it is tax-free at the state level. Now that we've covered the formula and the different levels of taxation, I'm going to get into the first strategy that we use with clients, and it's the simplest one, which is just deciding to delay Social Security to a later age. So if clients already have streams of income, whether it's full-time employment, part-time employment, rental income, investment income, all that income counts towards that provisional income formula that we just talked about. So we might say, hey, if you turn on Social Security now, you're going to pay 85% tax on that Social Security benefit at a relatively higher rate. So why not just delay it until you have less income, then turn on your Social Security benefit? It could, one, be subject to less taxation overall, and for the amount that is taxable, it could be taxed at a lower rate. The second related strategy associated with delaying Social Security is, again, I mentioned Social Security can represent taxable income at the federal level. So it's already starting to fill up those lower tax brackets. By delaying Social Security, there might be more opportunities to take pre-tax contributions out of retirement accounts and pay at a low tax rate, or do Roth conversions, which are also taxable. So there's a very strategy by saying by delaying, we're opening up those lower brackets that we can fill up with other types of income. Which brings me to the next strategy, which is drawing down pre-tax retirement accounts prior to turning on your Social Security benefit. So for individuals that have pre-tax traditional IRAs or 401ks, since those Social Security benefits can be taxed sometimes at the federal level. We might intentionally say, we don't want that income on the table right now. We first want to take money out of your pre-tax retirement accounts, pay tax on that money at a fairly low rate before we add more income from Social Security to the table. And also with pre-tax retirement accounts, there are RMDs waiting for you down the road, which are called required minimum distributions, that at 73.75, you're forced to take taxable money out of those retirement accounts. And if you wait too long, those RMDs could be large. And then if those RMDs are large, adding more taxable income, it can make your Social Security subject to either higher tax rate or a larger portion of your Social Security could be subject to taxation. The next Social Security tax strategy, interrelated with what we just covered, is actually being able to do Roth conversions before turning on your Social Security benefits. So when you do Roth conversions, you're intentionally moving money from a traditional IRA to a Roth IRA, which creates a tax event. So for clients that it makes sense to do that, if they turn on their Social Security benefit, that is filling up those lower tax brackets, and they do a Roth conversion, making those Roth conversions subject to a higher tax rate, versus we say, wait on Social Security, that allows you to do more Roth conversions, which, like we just talked about, lowers the balance in your pre-tax IRAs, making the RMDs lower down the road, again, potentially making your Social Security benefits subject to lower tax rates over the long term. The next strategy involves taking what's called a qualified charitable distribution, or QCD, from your traditional IRA account to help lower your provisional income, which in turn is lowering the amount of your Social Security subject to taxation at the federal level. The way these QCD works are you're allowed to send money directly from your traditional IRA to a charity, not-for-profit, or church. And if you do that, you don't have to pay tax on those distributions. And remember, the overall goal is if we can keep your provisional income low enough, it can lower the amount of your Social Security that's subject to taxation at the federal level. So if you're under 70.5, this won't work. You got to wait until you're over 70.5 to do these, but it can reduce the balances in your pre-tax retirement accounts subject to RMDs down the road. And again, if you are already subject to RMDs, let's say you're 76, 77, you're already having to take this required minimum distribution each year, those QCDs count towards your RMD, but it doesn't raise your taxable income. So let's say we have someone who has an RMD for the year of $20,000. They could send all $20,000 to a charity. They have satisfied their RMD requirement, and then that $20,000 doesn't show up in that provisional income calculation. The next strategy involves the municipal bond interest mistake. So a lot of people have municipal bonds during their working years when they're high income brackets, and they make the mistake of continuing to have municipal bond to the retirement years when they might be in a really low bracket. So we're like, yep, tax-free interest made sense when you're in a really high bracket, but now that you're in a lower bracket, municipal bond interest might not make sense anymore. It might be better to hold corporate, something that's taxable, and you're more than happy to pay tax on that interest because you're in a low bracket. But from a Social Security standpoint, they take that tax-free interest and they add it back into your income for the purpose of that provisional income formula. So it's almost like a double hit. If you're still getting municipal bond interest and you're already in a low bracket, one, you're not getting the big tax benefit, and two, it's not helping you out from a Social Security taxation standpoint. Taking a number of these strategies and implementing them into a well-architected distribution strategy can reduce a retiree's overall tax liability by thousands and thousands of dollars over their lifetime. I hope this information was helpful. If you have any questions, please feel free to reach out to me at greenbushfinancial.com. Thank you.